Hello everybody, this is Steve Rising with Thin Slice Trading at the Forex Trading Institute. Just like to take a few minutes today to talk about typical daily Forex price action in the currency pairs. We'll start off here with Euro USD, one of the more popular pairs here. And today is November 29th, so the vertical line that we see here almost in the middle of the chart here represents the start of the day. As the job of a trader is really first and foremost to understand how to interpret price action. Really the key elements that a trader needs to learn to trade, whether it's a currency pair or for that matter any market, is interpreting and understanding price action so they can identify high probability conditions versus low probability conditions. And part of the way that we do that is also through pattern recognition. And these patterns that we see become very repeated, and we look for the higher probability patterns to then consider placing a trade. Many times the novice or neophyte trader feels like that all they have to do is just look at the market, determine direction, and then jump in, and what they're really doing is relying on hope and luck that ultimately the trade is going to end in a profitable trade. We have to remember here 2011, the way markets trade in the last 5 to 6 years is entirely different than the way markets traded, for instance, 10 years ago. And a big impact is electronic trading, the ability for people to access markets real-time electronically. Charting applications are now readily accessible. So the way that we approach and look at markets has to change as well. A large majority of information out there is based on trend-following techniques. The reality is trend-following techniques were developed prior to electronic trading. Most trend-following techniques are 30, 40, in some cases 50 years old. And we look at just the volume of market activity 30 or 40 years ago in the 70s and the 60s. And we look at volume today, just the increase in volume makes a dramatic difference in the way markets trade. So it's important to understand that we really need to have a little more of a new approach and look at markets from a different perspective than oftentimes what's considered conventional wisdom. And it's also important to understand that electronic trading is still relatively young in the scheme of things. Most people really didn't have access to high-speed internet until approximately 5 to 7 years ago, and online trading, electronic trading, has really taken off in just the last 3 to 5 years. The reason I bring these points up is I see over and over in the 10 plus years that I've been teaching people how to trade is folks typically go to methods or processes of trading that are decades old, and they're not really applicable in today's market conditions. So one of the key characteristics of the currency pairs or the Forex market is that the directional bias is constantly changing, and we see this day in and day out, and this is very representative in the Euro USD today. We can see, for instance, once again, here is the start of our day right here, and then as we move into Eurozone session, we had a little bit of bearish activity where price went south slightly. And then ultimately we had a reversal and price moved north. And a key point to remember is this move that we have, this bullish move that we have, which is actually a form of a breakout move where price cleared here our closest significant number, that this move is happened in under 30 minutes from beginning to end. And this is another critical factor for folks to understand, that each one of these candlesticks that we're looking at represents 10 minutes in time, and the majority of the move is right here, and it happened in less than 30 minutes. And so then price topped out just as it touched what we label with the thin slice methodology, our speed bump to the north side of our next significant number. We then had a form of past resistance becoming past support becoming future resistance at this point, indicating then the directional bias shifting and then price moving south. And we can see now as we move forward here to the afternoon portion here, price is back to its point of origin, which once again was our significant number that we started trading on either side of here at the beginning of the Eurozone session here. And now typical condition is now price is going to go flat. So the key here is there is no trend-based characteristic that we're looking at here. What we see is these very short-lived moves that occur. The first one here, this bullish move, is a form of market momentum. Remember, momentum represents short-term quick moves. Trend-based moves represent overall tendencies of the market. So oftentimes I see nowadays where folks will label any type of move a trend-based move, and in fact it's just not the case. So then we can see, once again, move to the south side. The majority of the move here we can see happened in just about 30 minutes as well, and price is flat. So the two primary moves that occurred here today on Euro USD, one was bullish. An hour later we shifted direction, the other was bearish. And the critical element to understand about this constant shift in the directional bias is indicators can't pick up these moves because they happen too quickly. The reality is all indicators are lagging in information, and by the time they pick up these moves, it's too late. The indicator reacts after the fact. The reality is the only predictive indicator that we have is interpreting and understanding price action. So once again, one of the key characteristics of a currency pair is the directional bias is constantly changing. We can see this a little better on a 30-minute chart, where we can see here, once again, the move here, the bullish move that occurred today. We can see what happened in one 30-minute window. Once again, when our significant number was cleared, price then topped out, created the high for the day, and reversed here and moved in the other direction. The other thing we can pick up from this 30-minute chart here is we can also see here that here is Sunday open of Forex. So beginning of the week here, Monday, at this point right here, we can see here, same situation, Monday's trading day is, we've got the exact same situation here. One quick bullish move right here, and then we topped out, and then we went bearish, moving into the next corresponding session. So it's critical to understand that with a currency pair, they're primarily in range-bound conditions. So the easier way, or the more effective way, to consistently take advantage of these very short-lived moves in a currency pair is to become versed in a scalping technique, because a scalping technique lets us take advantage of these quick little bursts to the north, then topping out in these quick little bursts to the south. We don't have to be reliant on indicators, and we can also, as we can see, we can work off of very quick, tight stops because the moves are very short-lived. Another benefit is we're in the markets for a very short period of time. We would prefer to plan when we can see these moves, which is part of what we teach here at the Forex Trading Institute with thin slice trading methodology. But the key here is once again, as we can see that directional bias is constantly shifting. Just to take a look here at a couple more pairs here, we can go to USD CHF. You can see that pattern very prevalent here. Once again, quick move to the south. We bottom out at a significant number. Price then reverses around, and then one more bullish move. And once again here, we can see here where price is now trading right back to its point of origin at the beginning of the day. Once again, a very critical pattern for the solid FX trader to learn is this constant shift in the directional bias, which relates to strategy number 2 of the 7 black and white strategies that we teach with the thin slice methodology. And then lastly here, as we come to the close of this quick short video here, we can see exact same situation here on another pair, USD CAD, same situation, quick bearish move in the Eurozone session, and then moving around into the next session, the start of the American session, the 7-11 session. We can see here that even a shorter lived little bullish push here. This push relates to strategy number 7 that we teach here, which is trading fundamental announcements. We had an 8:30 number go off this morning, and this was a trading setup for us, and we can see also very short-lived. Another benefit of learning a scalping technique is we can go in and take advantage of these moves, because even in a short-lived 20-pip move like we have right here, trading 5 full lots on one 20-pip move still equates to, after transaction costs, net 5 lots, and one net 20-pip move equates to $1,000 in a relatively short period of time. So we can work with tighter stops. We can achieve our profit target in a shorter period of time. And the real key benefit is, as we see in market volatility, uncertainty across the globe, uncertain economic conditions, the U.S. zone side of things, uncertain economic conditions in Eurozone side of things, big fluctuations in not only the equities market but other markets as well. It doesn't really make sense to stay in any market for extended periods of time. So one of the real benefits of trading the Forex market, we can get in, grab that quick move that happens, get out, achieve our profit, and then we're flat at the end of the day. No lost sleep, staying in trades for extended periods of time. So I encourage you to take a look at our website to learn more about these constant range-bound conditions and shifts in the directional bias that is the prevalent condition in a currency pair. At our website, theforextradinginstitute.com, there's a number of free videos as well as additional supplemental information. So once again, this is Steve Rising with the Forex Trading Institute. Thank you for your time in viewing this quick short video on typical FX price action where the directional bias is constantly changing, meaning in 1-2 hour window we're bullish, we go flat for typically 60 minutes, and then we find ourselves in the very next trading session or in the next window we're moving in the exact opposite direction. So this is another reason also in closing why there is typically such a high failure rate in trading in general as well as trading the Forex, is because many times folks think they've discerned the direction price is going to move, are in the expectation that that's going to happen for an extended period of time, and literally what happens is 20 or 30 minutes later we just top or bottom out and move in the exact opposite direction. So once we grasp the concept of this constant change in direction of price in the Forex market, we're on our way to becoming solid, successful traders. So once again, thanks for your time. I'm out of here.